Good morning, everyone. Yesterday saw what will probably be recognized as a historic moment in central banking. In October 1979, the US Fed changed its approach to monetary policy and began to target the quantity of money in an effort to subdue stubbornly high inflation in the US. That decision set off several decades of experimentation as central banks around the world tried different ways to get inflation under control. Though there was a lot of discussion and debate about the best way to achieve that goal, there was never much controversy about the goal itself. Yesterday, that era effectively came to an end, as the Bank of England, in its quarterly inflation report, forecast that inflation was going to exceed its target for at least the next 3 years, and yet said it would do nothing about it. On the contrary, it stood by its previous pledges to ease further if warranted by the growth outlook, although it didn't give any hints that it was in fact planning to do that. This shows that the bank has already settled on what's called flexible inflation targeting, the new fashion among central bankers as advocated by Bank of England Governor-designate Mark Carney. This represents a radical change in central bank thinking and is distinctly negative for the pound. In effect, the bank is acquiescing to the government's debasement of the currency, out of concern that tightening monetary policy would risk derailing whatever recovery there is. Well, if the government and the bank aren't concerned about the domestic value of their currency, they probably won't be concerned about its international value either. I was bearish on sterling before, but I'm even more bearish now. I think traders who are looking to establish a position should consider selling sterling against either the dollar or the euro. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.